A retired couple sells a small piece of stock to help their granddaughter with college. Another retiree does a Roth conversion because someone told him it was smart tax planning. A widow sells the family home after her husband dies because the house is too much to manage alone. Nothing about those choices sounds dangerous, but 2 years later, a letter arrives from Social Security, and suddenly the Medicare premium is higher than expected. The retiree looks at the letter and thinks, what did I do wrong? In many cases, nothing was wrong. That is what makes this so unsettling. There is a Medicare surcharge that retirees can trigger without realizing it. It is called IRMAA, which stands for Income-Related Monthly Adjustment Amount. It can increase what you pay for Medicare Part B, and it can also add an extra charge to Medicare Part D drug coverage. Medicare uses modified adjusted gross income from your IRS tax return from 2 years ago to decide whether the extra charge applies. For 2026, Medicare says the standard Part B premium is $202.90, but higher income beneficiaries may pay more based on their 2024 tax return. And here is the part that catches people off guard. This surcharge is not always triggered by being rich. Sometimes it is triggered by one unusual year, one home sale, one retirement account withdrawal, one Roth conversion, one spouse passing away, one investment account decision that looked harmless at the time. So do not panic. But do pay attention, because later in this video, I'll give you a simple checklist of what to review before you accidentally create a Medicare premium surprise for yourself or your spouse. Most retirees think of Medicare as something separate from their tax return. You pay your premium, you pick your coverage, and as long as you enrolled correctly, you assume the amount is the amount. But Medicare premiums can be connected to your tax return in a way many people do not see coming. Social Security looks at information from the IRS. If your modified adjusted gross income is over a certain threshold, Social Security can determine that you owe an income-related adjustment. According to Social Security, MAGI for this purpose is adjusted gross income plus tax-exempt interest income. That one sentence matters more than it sounds, because a retiree may say, I did not get a raise, I am not working full-time, I am living on Social Security and savings, why did my Medicare go up? The answer may be buried in something that happened 2 years earlier. Maybe they sold appreciated stock, maybe they cashed out part of an IRA, maybe they sold a second property, maybe they converted traditional retirement money to a Roth IRA, maybe they received a large pension payout, maybe a widow went from filing jointly to filing as a single person and the income threshold changed. The danger is not that the retiree is careless. The danger is that the system follows the numbers on the tax return. For 2026, Medicare says a person filing individually may pay IRMAA if 2024 modified adjusted gross income was above $109,000. For married couples filing jointly, the threshold is above $218,000. Now, some viewers may hear those numbers and think, that does not apply to me. Maybe it does not, but keep listening, because this is where many retirees make the wrong assumption. The surcharge is not based only on your normal retirement income. It may be based on a temporary spike. That spike can come from a decision you make once and forget about, and Medicare does not forget it 2 years later. Let's start with a fictional example. Imagine a retired school secretary named Elaine. She is 72. She is careful with money. She is not wealthy, but she and her late husband saved steadily. They bought their home decades ago. They had a modest IRA. They had a taxable brokerage account with a few old mutual funds. After her husband dies, Elaine feels overwhelmed. The house is too large. Her daughter suggests selling it and moving closer to family. Elaine sells the home. She also sells some investments to pay moving expenses and to buy into a retirement community. The decisions are reasonable. No one is trying to game the system. No one is hiding money. Elaine is simply adjusting to life as a widow. Then, 2 years later, her Medicare premium rises. Elaine thinks it is a mistake. She calls her daughter and says, I thought Medicare was supposed to be the stable part of retirement, but the letter is not about this year. It is looking backwards. That is the first hidden rule. The surcharge has a rear-view mirror. Medicare does not usually look at what you feel you can afford right now. It looks at tax information from 2 years ago. That means a financial decision you made in a stressful season may show up long after the money is gone. This is why retirees can feel blindsided. The sale happened in 1 year. The premium increase arrives in another year. By then, the retiree may not connect the two. And that delay is what makes IRMAA feel like a trap. But it is not a trap in the sense that the rule is secret. It is a rule many people simply are not warned about before they make a major financial move. Here is the next part most people miss. IRMAA is not only about Medicare Part B. If you have Medicare prescription drug coverage, Part D, higher income can also create an added amount for drug coverage. Social Security explains that if you have both Part B and Medicare prescription drug coverage, higher premiums may apply to each. That means the surprise can hit in 2 places. A retiree may focus only on the doctor insurance premium and miss the drug coverage adjustment. Or they may notice a Social Security check is smaller and not understand why. In some cases, the extra amount is deducted from Social Security benefits. In other cases, depending on how someone pays, they may receive a separate bill. Now let's talk about the most common triggers. The first trigger is a large retirement account withdrawal. Many retirees have money in a traditional IRA, 401k, 403b, or similar account. That money may have grown tax-deferred for years. But when you take money out of many traditional retirement accounts, it can show up as taxable income. That taxable income may increase your adjusted gross income, and if it pushes your modified adjusted gross income over an IRMAA threshold, it may raise your Medicare costs 2 years later. This is where a harmless decision becomes expensive. A retiree says, "I need $40,000 to replace the roof." Another says, "I want to buy a reliable car before prices go up again." Another says, "I'm going to help my son with a down payment." The withdrawal may be necessary. The family may truly need the help. The roof may need to be replaced. But the Medicare consequence should be part of the conversation before the withdrawal happens. The issue is not whether you are allowed to use your own money. Of course you are. The issue is timing. Taking a large amount in December may create a different result than spreading withdrawals across 2 tax years. Pulling from a traditional IRA may create a different result than using cash savings or another source. The right answer depends on your situation, and this is where a qualified tax or financial professional can help you model the impact before you act. The second trigger is a Roth conversion. A Roth conversion can be a useful planning tool for some retirees. The idea is that you move money from a traditional retirement account into a Roth account, pay tax now, and possibly create tax-free treatment later if rules are met. But the conversion amount may count as income in the year of conversion. That does not mean Roth conversions are bad. It means they need to be planned carefully. A retiree may hear, "Convert before tax rates change," or "Convert before required withdrawals get larger," and rush to move a large amount in 1 year. Then, 2 years later, the Medicare letter arrives. The conversion may still have been worth it, but if no one included Medicare premiums in the calculation, the retiree did not see the full cost. This is where the usual advice can backfire. Good tax planning in one area can create a hidden cost in another area. The third trigger is selling investments in a taxable account. This one catches careful savers. A retiree may own mutual funds, stocks, or other investments outside retirement accounts. These may have grown for years. Selling them can create capital gains. Some funds can also distribute capital gains even if the retiree did not personally sell shares. So a person may say, "I did not take a big IRA withdrawal. Why did income jump?" The answer may be in the brokerage tax forms. This is especially important for retirees who use investments to create spending money. You may look at your bank account and think you simply moved money from one pocket to another, but the tax return may tell a different story. The fourth trigger is selling a home or property. Many retirees assume selling a primary residence is always tax-free. It may not be that simple. The IRS has rules that may allow qualifying homeowners to exclude part of the gain on the sale of a main home. The commonly referenced exclusion is up to $250,000 for many single filers and up to $500,000 for many married couples filing jointly if requirements are met. But gain above the exclusion, or sales that do not meet the rules, may create taxable income. This is one reason widows and widowers need special care before selling a long-owned home. The emotional decision is already heavy. The surviving spouse may be grieving, downsizing, moving closer to children, or trying to simplify life. But the tax result can affect more than the tax bill. It can affect Medicare premiums later. And it is not just the family home. Selling a rental property, vacation home, land, or inherited property can also create tax consequences, depending on basis, gain, depreciation, and other rules. Do not assume the closing table is the end of the story. For Medicare purposes, the tax return may still speak 2 years later. The fifth trigger is the widow or widower filing status shock. This one is not talked about enough. When both spouses are alive, a married couple may file jointly and use the joint IRMAA thresholds. But after one spouse dies, the survivor may eventually be treated as a single filer for tax purposes, depending on the year and the rules that apply. That can be painful because household income may not fall in half. A widow may still have pension income, Social Security survivor benefits, IRA withdrawals, investment income, and taxable interest. But the threshold for a single filer is lower than the threshold for a married couple filing jointly, so the surviving spouse may feel punished twice. First, they lose their partner. Then they face a different tax and Medicare premium picture. This does not mean every widow or widower will pay IRMAA, but it does mean the survivor should not assume the old plan still works. The retirement income plan that worked for 2 people may need to be rebuilt for 1. The sixth trigger is tax-exempt interest. This surprises people because the phrase tax-exempt sounds safe. Social Security says MAGI for IRMAA includes adjusted gross income and tax-exempt interest income. So a retiree may own municipal bonds and think, this income is tax-exempt, so it will not matter. For regular income tax purposes, tax-exempt interest may be treated differently, but for IRMAA, it can still be part of the calculation. This is why retirees should not rely on casual phrases. Tax-exempt does not always mean invisible. The seventh trigger is part-time work plus retirement income. Some retirees go back to work part-time. Maybe they want structure. Maybe they want to help with rising costs. Maybe they enjoy driving a school bus, consulting, working at a local shop, or helping a former employer. That income can be useful. It can also stack on top of pensions, Social Security, IRA withdrawals, interest, dividends, and capital gains. A small job alone may not create a problem, but a small job plus one large investment sale plus one retirement withdrawal may push the tax return into a different category. This is the pattern to watch. IRMAA is often not caused by one thing. It is caused by several reasonable things happening in the same tax year. Now let's pause and make this practical. The Medicare surcharge is based on income ranges. That means crossing a threshold matters. In the official 2026 Medicare cost table, the standard Part B premium is $202.90. But if 2024 income is above the first threshold, the monthly Part B amount moves higher. The table shows higher monthly amounts at each income level. This is not like a normal tax bracket where only the dollars above a line are taxed at a higher rate. With IRMAA, crossing into a higher income range can change the premium category. That is why being slightly over a threshold can feel so frustrating. A retiree may say, "Are you telling me a small amount of extra income can raise my premium?" In some cases, yes. That is why planning before year-end can matter. But here is the good news. IRMAA is usually not permanent just because it happens once. If the income spike was temporary, the surcharge may change in a later year when newer tax information is used. And if your income has gone down because of certain life-changing events, Social Security has a process to ask for a reduction. This is where Form SSA 44 matters. Social Security's SA 44 matters. Social Security's SA 44 form is for a Medicare income-related monthly adjustment amount life-changing event. The form says it may be used if you received a notice that your Part B or prescription drug coverage premiums include IRMAA and you experienced a life-changing event that may reduce your IRMAA. Social Security lists life-changing events such as marriage, divorce, death of a spouse, loss of income, and an employer settlement payment. This is critical. If the premium increase is based on an old tax return and your current income is lower because of a qualifying life event, you may not have to simply accept the higher amount without asking questions. But do not assume every income drop qualifies. Selling investments one year and having less income the next year may not always fit the life-changing event rules by itself. This is why you should read the notice carefully, review the SSA 44 instructions, and contact Social Security or a qualified professional if you are unsure. Now, before this sounds overwhelming, here is the plain English version. There are 3 questions every Medicare retiree should ask before creating a large taxable event. First, will this move increase my adjusted gross income? Second, will it add tax-exempt interest or other income that counts toward Medicare's MAGI calculation? Third, could it push me over an IRMAA threshold for the year? Those 3 questions can prevent a lot of confusion. Let's return to Elaine, the widow in our example. Elaine's daughter finally sits down with her and reviews the letter. They realize the Medicare increase was not based on Elaine's current monthly budget. It was connected to the year she sold investments and moved after her husband died. At first, Elaine feels angry. Then she feels embarrassed. She says, "I should have known." But that is not fair. Most retirees are not warned about this until the letter arrives. They are told to save. They are told to invest. They are told to downsize. They are told to consider Roth conversions. But they are not always told that Medicare premiums can react 2 years later. So Elaine and her daughter do 3 things. They keep the Social Security letter. They pull the tax return from the year Social Security used. They schedule a meeting with a tax professional before making any more large withdrawals. That is not panic. That is control. And control is the whole point of this video. Here is the checklist to review before you trigger this surcharge without knowing it. Before you sell a large investment, ask whether the sale creates taxable gain. Before you take a large IRA or 401k withdrawal, ask whether spreading the withdrawal across more than one tax year could reduce the Medicare premium impact. Before you do a Roth conversion, ask your tax professional to calculate not just the income tax, but also the possible IRMAA cost 2 years later. Before selling a home, rental, land, or vacation property, ask what portion of the gain may be taxable and whether it may affect Medicare premiums. Before a surviving spouse changes the retirement income plan, review how filing status and income thresholds may change. Before assuming municipal bond interest is harmless, ask whether tax-exempt interest is part of the Medicare MAGI calculation. And when you receive a Medicare premium letter from Social Security, do not toss it in a drawer. Read which tax year they used. Check whether the income number matches your return. Then ask whether a life-changing event applies. The action step is simple. Create an an IRMAA review folder. It does not need to be fancy. Put in your most recent tax return, your Social Security Medicare premium notice, a list of planned large withdrawals, a list of investments you may sell, and any upcoming home or property sale information. Then, before December 31st, ask a qualified tax professional or financial professional one direct question. Could anything I am doing this year increase my Medicare premiums 2 years from now? That one sentence may save you from a surprise later. The Medicare surcharge retirees often trigger without knowing it is IRMAA. It may affect Part B. It may affect Part D. It is based on modified adjusted gross income from a prior tax year, and it can be triggered by normal retirement decisions, withdrawals, conversions, property sales, investment gains, tax-exempt interest, part-time work, or a change in filing status after the death of a spouse. This does not mean you should avoid every financial move. It means you should stop treating Medicare premiums as separate from tax planning. The rule is simple, but the consequence can be expensive. 1 year of higher income can echo into a future Medicare bill. One unplanned withdrawal can make a Social Security check smaller than expected. One home sale can create a surprise long after the moving boxes are unpacked. But once you know the rule, you can ask better questions. That is the difference between fear and protection. Before you make a major retirement money move this year, check the Medicare impact before you act. Comment Medicare if you want a simple checklist of the retirement income moves that may trigger IRMAA. Share this with a spouse, widow, widower, or adult child who helps with family paperwork. And before changing withdrawals, investments, tax filing choices, or property plans, review your situation with a qualified tax, legal, or financial professional who understands your state and your full retirement picture. The goal is not to panic. The goal is to keep more control over your retirement income before a letter arrives and tells you what already happened.